If you've recently inherited money or property, you may be wondering if you're going to get hit with a tax bill. The short answer, generally speaking, no, you're not. But let's break it down to help you to avoid any surprises and to give you a better understanding of what that could even look like for you. So, I want to talk about an inheritance tax, but I think before we do so, I have to explain the difference between inheritance tax and estate tax because those are two different things. And a lot of people will confuse them, and I understand why. So, let's break that down. An estate tax is a tax on the estate, whether it's a probate estate or a trust estate, and it's paid by the estate before anything is distributed to any of the heirs. Okay, so it comes off the top, paid by the estate, versus an inheritance tax is a tax that is paid by the beneficiary, by the recipient of the inheritance. That is state by state. Most states do not have an inheritance tax. Washington state does not have an inheritance tax. Some states do. I'm only licensed in Washington, so Washington state does not have an inheritance tax. It does have an estate tax, and we'll get into that in just a moment here. So, at the federal level, the IRS does not tax the inheritance itself. So, at the federal level, with your annual tax return, you typically do not owe income tax on the inheritance itself. However, if that inheritance produces income, like rental income or dividends or a capital gains, like that income could be taxable. But that's not an inheritance tax. That is a different type of tax. Okay, if you have specific tax questions, you probably should be talking to a CPA or tax preparer. I'm kind of giving some general advice here. Again, I'm only licensed in Washington state, so I'm trying to give some general guidance here. But if you have specific tax questions, you probably need to talk to, again, a CPA or tax preparer. Okay, let's go on to state inheritance taxes. Again, Washington state does not have an inheritance tax, so if you are in Washington state, you don't have to worry about that. But we do have an estate tax here. That threshold as of July of 2025 is $3 million. So if the person who passed away, if they passed away in July of 2025 or later, if the value of their estate is under $3 million, there should not be an estate tax bill. The first $3 million is exempt. If the value is over $3 million, that first $3 million is exempt from any estate tax, and the amount that's over the $3 million would be subject to the estate tax. So, for example, if the estate was worth $4 million, the first $3 million, no estate tax. That last $1 million that's over the 3, it's going to be subject to an estate tax. Again, if we need specific tax advice, please talk to a CPA, talk to a tax advisor. We want to make sure that you get the correct detailed information based on the facts of your case and your circumstances. General tax advice may not always apply to everyone, but this is just some general guidance and information for you to have because it's a question that I see a lot as an estate planning attorney. And so I want to try to give you some guidance and just some expectations of what you may or may not see if you are inheriting anything from someone's estate. Now, there can be some special circumstances where there could be possible taxes on that. So if you inherit like an IRA or a 401k, usually distributions are taxable when you withdraw them. Again, generally speaking, for IRAs and 401ks. For other inherited property, you will usually get a step up in basis, meaning that you only pay capital gains on the increase in value after the person's death if you pass away. So let's do an example because that might sound a little convoluted and confusing. So let's say somebody passed away and you inherited a home, and let's just, for easy numbers, let's say it's currently worth $400,000 when they passed away. Let's say when they bought it, it was worth $200,000. So that person's basis in the home was $200,000. When you inherited it after they've passed away, it is worth $400,000. Your basis in that property steps up to the $400,000. So you don't have to take on the same basis that the decedent had in the property. At $200,000, you get the step up in basis to the higher value as of the date of death, which is $400,000. So for capital gains tax purposes, you would only pay capital gains tax on any appreciation over the $400,000. So the property was worth, let's say you sold it a year later and it was worth $420,000. The capital gains tax would be only based on that $20,000 increase in value from the $400,000 that you bought it at. I hope that makes sense. It's kind of a complicated concept. I try to make it simple. So that's how the capital gains tax works. And so where you could possibly see a capital gains tax if the property appreciates after you've inherited it. But again, that's not an inheritance tax. All right. And then let's talk about life insurance policies. If you inherit a life insurance policy, they generally pass tax-free to the individual. So generally speaking, you should not be receiving a tax bill for a life insurance policy that you received from somebody passing away. So again, let's wrap things up because I don't want to make this more complicated than it needs to be, but it can be very complex, which is why it's so valuable to have a CPA or tax preparer to assist in these kind of situations. So again, in most cases, beneficiaries will not pay an inheritance tax on what they've inherited. At the federal level, there is not inheritance tax. At the state level, only a handful of states actually have that inheritance tax. Washington is not one of them. But when you inherit property from someone, if that generates income for you, like let's say it's a rental property and you're getting rental income from it, that rental income is going to be taxable to you. Not the receiving of the house, but the income it generates for you. Or if you have investments that you've inherited and those generate interest or dividends for you, again, that's where the tax bill could come. And so if you are inheriting property or retirement accounts or other assets, make sure you're talking to an attorney and or a tax professional, a CPA, to make sure we are doing what we can to help you to minimize or reduce taxes. And so also along those same lines, if you don't have an estate plan in place and you want to get your estate plan done and you're considering what a tax bill could look like for your estate, if you're over that $3 million mark, reach out to our office. We'd be happy to help you to see if we can assist you with your estate plan, with the will or with the trust, to help minimize or eliminate any taxes for your estate. And so feel free to leave a comment down below if you have a question. I try to answer questions in the comments as best I can. Sometimes some questions are very fact specific and I can't do so. It requires an actual one-on-one consultation. But if I can give general, advice or guidance, I will do so. So feel free to put that below in the comments. And if you want to learn more about estate planning or probate or residential real estate, that's what we talk about here on this channel in Washington State. So stick around, subscribe, like, do all the things, and I'll see you in the next one. All right, bye.